Question 1. An individual who holds a life insurance policy and has the right to exercise all policy privileges is known as the A. Beneficiary, B. Annuitant, C. Insured, D. Policy owner. Answer: D. Policy owner. The policy owner is the individual or entity who holds all the ownership rights in a life insurance policy, including the ability to name or change beneficiaries, assign the policy, or borrow against its cash value. While the insured is the person whose life is covered and the beneficiary receives the death benefit, only the policy owner possesses the contractual rights to control the policy. Think of the policy owner as the boss of the policy. They make all the decisions. Question 2. Which of the following statements regarding the free look provision in California life insurance policies is true? A. It applies only to policies with a cash value. B. It allows the policy owner a minimum of 10 days to return the policy for a full refund. C. It applies only to group life insurance policies. D. It allows the insurer to charge a surrender fee if the policy is returned within the free look period. Answer: B. It allows the policy owner a minimum of 10 days to return the policy for a full refund. The free look provision, also known as the right to examine period, is a mandatory clause in California life insurance policies that gives the policy owner a specified period, typically 10 days, to review the policy after delivery and return it for a full refund of all premiums paid if they decide it's not suitable. This consumer protection allows buyers to fully understand their purchase without financial penalty. For seniors 60 and older, California law extends this period to 30 days, so always be aware of the specific timeline based on age. Question 3. In California, what is the primary purpose of the California Life and Health Insurance Guarantee Association, CLHIGA? A. To regulate insurance rates and policy forms. B. To protect policy owners, insureds, and beneficiaries against the insolvency of an insurer. C. To investigate fraudulent insurance claims. D. To license and oversee insurance agents. Answer: B. To protect policy owners, insureds, and beneficiaries against the insolvency of an insurer. The California Life and Health Insurance Guarantee Association, CLHIGA, was created to provide a safety net for policy owners in the event that a member insurance company becomes financially insolvent. This association steps in to ensure that eligible policy benefits, up to certain limits, are paid even if the original insurer cannot fulfill its obligations. It essentially acts as a financial backstop, giving consumers confidence that their policies are protected. Remember, it's a guarantee association, directly pointing to its role in safeguarding policy benefits. Question 4. Which life insurance policy allows the policy owner to vary premium payments and face amount, and offers a cash value that accumulates on a tax-deferred basis with a flexible death benefit? A. Whole life. B. Term life. C. Universal life. D. Variable life. Answer: C. Universal life. Universal life insurance is characterized by its flexibility, allowing policy owners to adjust both the premium payments and the death benefit within certain limits. It builds cash value that grows on a tax-deferred basis, similar to whole life, but provides greater control over the policy structure. The flexible nature of premiums and death benefits is the key identifier for universal life, distinguishing it from the fixed structure of whole life or the temporary nature of term life. Question 5. All of the following are typically considered an unfair trade practice in California except: A. Twisting. B. Rebating. C. Replacement. D. Defamation. Answer: C. Replacement. Replacement is the act of purchasing a new life insurance policy while surrendering or terminating an existing one, and while it requires specific disclosure rules to protect consumers, it is not inherently an unfair trade practice. Unfair trade practices, such as twisting, inducing policy lapse to buy another policy with the same insurer for the purpose of earning a commission, rebating, offering a portion of the commission as an inducement, and defamation, making false statements about an insurer, are illegal acts designed to deceive or harm consumers or competitors. Replacement is a regulated transaction, not an illegal act. Question 6. What is the primary purpose of the incontestability clause in a life insurance policy? A. To allow the insurer to contest claims for any reason for the first 2 years. B. To prevent the insurer from denying a claim based on misstatements in the application after a specified period. C. To allow the policy owner to contest premium increases after the first year. D. To prohibit the policy owner from making changes to the policy after it is issued. Answer: B. To prevent the insurer from denying a claim based on misstatements in the application after a specified period. The incontestability clause states that after a policy has been in force for a specific period, usually 2 years in California, the insurer cannot deny a claim based on misstatements made by the insured in the application, even if those misstatements were material. This protects beneficiaries from an insurer trying to void a policy years after it was issued, even if the insured unknowingly provided incorrect information. It provides certainty for policy owners that their coverage will not be challenged after a reasonable time frame. Question 7. A payer benefit rider in a juvenile life insurance policy provides that A. Premiums will be waived if the child becomes disabled. B. Premiums will be waived if the parent/guardian paying the premiums becomes disabled or dies. C. The policy will pay out a lump sum if the child requires special medical care. D. The policy's cash value will be accessible for college tuition. Answer: B. Premiums will be waived if the parent/guardian paying the premiums becomes disabled or dies. A payer benefit rider is specifically designed for juvenile policies, ensuring that if the designated premium payer, typically a parent or guardian, dies or becomes totally disabled, the premiums on the child's policy will be waived until the child reaches a certain age, often 21 or 25. This rider guarantees that the child's life insurance coverage remains in force even if the person responsible for payments is no longer able to pay. It protects the policy's continuity despite unforeseen circumstances affecting the adult payer. Question 8. Under California law, an agent must provide a buyer's guide and policy summary to a life insurance applicant. A. Only upon request from the applicant. B. Before accepting the initial premium. C. At or before the time of policy delivery. D. Within 30 days of policy issuance. Answer: C. At or before the time of policy delivery. In California, and most states, agents are required to provide a buyer's guide and a policy summary to life insurance applicants at or before the time of policy delivery. The buyer's guide offers generic information about life insurance, while the policy summary provides specific details about the policy being purchased, such as premiums, cash values, and surrender charges. This ensures the consumer receives comprehensive information about the policy and can make an informed decision. Question 9. Which settlement option provides a beneficiary with a guaranteed income for a specified period, after which payments cease? A. Interest only. B. Fixed period installments. C. Fixed amount installments. D. Life income. Answer: B. Fixed period installments. The fixed period installment settlement option pays the death benefit in equal installments over a predetermined period chosen by the policy owner or beneficiary. Once the period ends, the payments stop, even if the beneficiary is still alive. This contrasts with fixed amount installments, where the payment amount is fixed, and life income, which guarantees payments for the beneficiary's lifetime. Think of fixed period as a set calendar duration for payments. Question 10. The authority that an agent has that is not explicitly granted in a written contract but is necessary to perform the duties of the agency is known as A. Express authority. B. Apparent authority. C. Implied authority. D. Fiduciary authority. Answer: C. Implied authority. Implied authority is the unwritten authority that an agent has to perform acts that are reasonably necessary to carry out the duties granted by express authority. For example, an agent's express authority is to sell insurance, but their implied authority allows them to print business cards or collect initial premiums. This authority is presumed to exist because it's essential for the agent to conduct business on behalf of the insurer. Question 11. What is the primary purpose of the Medical Information Bureau, MIB? A. To provide insurers with credit reports on applicants. B. To collect and share medical information about applicants among insurers to prevent fraud. C. To conduct physical examinations for insurance applicants. D. To assist applicants in finding affordable health insurance plans. Answer: B. To collect and share medical information about applicants among insurers to prevent fraud. The Medical Information Bureau, MIB, is a non-profit association that operates as an information exchange for life and health insurance companies. Its primary purpose is to help insurers detect and prevent fraud, material misrepresentation, and non-disclosure in the application process by maintaining a database of medical and other health information shared among member companies. If an applicant provides inconsistent information to different insurers, the MIB report flags this, prompting further investigation during underwriting. Question 12. A policy owner has the option to surrender a whole life policy for its cash value. What is this value known as? A. Face amount. B. Death benefit. C. Non-forfeiture value. D. Annuity value. Answer: C. Non-forfeiture value. When a whole life policy with cash value is surrendered, the policy owner is entitled to receive the accumulated cash value, which is known as the non-forfeiture value. Non-forfeiture options are benefits built into cash value policies that protect the policy owner's accumulated equity if they stop paying premiums. The cash surrender value is one of these standard non-forfeiture options, along with extended term and reduced paid-up insurance. Question 13. Which type of life insurance policy is characterized by having a guaranteed death benefit and cash value, with premiums that remain level throughout the policy's life? A. Term life. B. Universal life. C. Variable life. D. Whole life. Answer: D. Whole life. Whole life insurance is a type of permanent life insurance designed to provide coverage for the entire life of the insured, up to age 100 or beyond. It features a guaranteed death benefit, a level premium, and cash value that builds on a guaranteed basis, making it predictable and stable. The whole life aspect refers to its coverage duration, which is for the insured's entire life. Question 14. What is the grace period for an individual life insurance policy in California if the insured fails to pay the premium on time? A. 7 days. B. 15 days. C. 31 days. D. 60 days. Answer: C. 31 days. In California, a grace period of 31 days is typically required for individual life insurance policies. This provision allows the policy to remain in force for a specific period beyond the premium due date, even if the premium hasn't been paid. If the insured dies during this grace period, the death benefit is usually paid, minus any overdue premium. This essential clause prevents immediate policy lapse due to a slight delay in payment. Question 15. In a contributory group life insurance plan, what percentage of eligible employees must participate? A. 50%. B. 75%. C. 100%. D. There is no minimum percentage. Answer: B. 75%. In a contributory group life insurance plan, where employees pay a portion of the premium, a minimum of 75% of eligible employees must participate to help prevent adverse selection, where only less healthy individuals would enroll. Conversely, for non-contributory plans, where the employer pays 100% of the premium, 100% of eligible employees must be covered. This participation threshold helps ensure a balanced risk pool for the insurer. Question 16. An agent who uses an existing policy's cash value to purchase another policy with the same insurer, solely for the purpose of earning a commission, is engaging in which illegal practice? A. Rebating. B. Twisting. C. Churning. D. Sliding. Answer: C. Churning. Churning occurs when an agent replaces or uses an existing policy's cash value to purchase another policy with the same insurer primarily for the purpose of generating new commissions, rather than for the policy owner's benefit. While twisting involves replacing a policy with a different insurer, churning specifically applies when the replacement is within the same company. This practice is illegal because it often leads to unnecessary costs and fees for the policy owner. Question 17. Which of the following is considered the most common type of permanent life insurance? A. Term life. B. Universal life. C. Whole life. D. Variable life. Answer: C. Whole life. Whole life insurance is widely considered the most common type of permanent life insurance because it offers consistent, lifelong coverage with level premiums and guaranteed cash value growth. While universal life and variable life are also permanent, whole life has historically been the most traditional and straightforward permanent option, appealing to those seeking predictability and simplicity. It's often the foundational permanent policy discussed. Question 18. What is the tax implication of the death benefit received by a beneficiary from a life insurance policy? A. It is always subject to federal income tax. B. It is generally received income tax-free by the beneficiary. C. It is taxable if the policy owner paid the premiums. D. It is taxable only if the death benefit exceeds a certain threshold. Answer: B. It is generally received income tax-free by the beneficiary. One of the most significant tax advantages of life insurance is that the death benefit paid to a beneficiary is generally received free of federal income tax. This means the full face amount of the policy is available to the beneficiaries without being reduced by income tax. While there can be exceptions for estate taxes in very large estates or if the policy was transferred for value, for most common scenarios, the death benefit is income tax exempt. Question 19. An annuitant begins receiving payments from an annuity that is designed to pay out for the rest of their life, with payments stopping upon their death. This describes which type of annuity payout option? A. Fixed period. B. Fixed amount. C. Life only. D. Joint and survivor. Answer: C. Life only. The life-only annuity payout option guarantees income payments for the annuitant's lifetime, but all payments cease upon their death, with no further payments made to a beneficiary. While this option provides the highest periodic income, it carries the risk of losing remaining funds if the annuitant dies early. It's often chosen by those who prioritize maximum income and do not need to provide for survivors after their death. Question 20. The period during which an annuitant makes payments into an annuity before beginning to receive income payments is known as the A. Liquidation period. B. Annuitization period. C. Accumulation period. D. Distribution period. Answer: C. Accumulation period. The accumulation period is the phase in an annuity contract when the annuitant pays premiums into the annuity, and the funds grow on a tax-deferred basis. During this period, the annuitant can typically make additional contributions and the cash value accumulates interest. This period ends when the annuitant decides to convert the accumulated funds into a stream of income, marking the beginning of the annuitization or liquidation period. Question 21. Which rider in a life insurance policy allows the policy owner to purchase additional insurance at specified future dates without proving insurability? A. Waiver of premium rider. B. Accidental death benefit rider. C. Guaranteed insurability rider. D. Term rider. Answer: C. Guaranteed insurability rider. The Guaranteed Insurability Rider, GIR, is a valuable addition that allows the policy owner to purchase additional amounts of life insurance at specific future dates, example every 3 years, or upon life events like marriage or the birth of a child, without having to undergo further medical exams or prove insurability. This means that even if the insured's health deteriorates, they can still increase their coverage, which is a significant benefit. It guarantees your insurability for future purchases. Question 22. When an insured individual dies, the life insurance policy's death benefit is typically paid to the A. Policy owner's estate. B. Insurer. C. Beneficiary. D. Agent. Answer: C. Beneficiary. Upon the death of the insured, the primary purpose of a life insurance policy is to pay the death benefit to the designated beneficiary or beneficiaries. The beneficiary is the person or entity chosen by the policy owner to receive the policy's proceeds. This direct payment mechanism avoids probate, ensuring quick access to funds for those intended to receive them. Question 23. All of the following are key personal uses of life insurance except A. Survivor protection. B. Estate creation. C. Retirement funding. D. Charitable giving. Answer: C. Retirement funding. While some permanent life insurance policies can build cash value that can be accessed later, their primary purpose and most efficient use are typically for survivor protection, estate creation, or charitable giving, not as a direct or primary retirement funding vehicle. Retirement funding is generally better served by qualified plans like 401(k)s or IRAs, which are specifically designed for that purpose. Life insurance provides liquidity and protection upon death, not primarily a retirement income stream. Question 24. A policy that combines term insurance and an investment component, allowing the policy owner to allocate premiums to a separate account, is known as A. Whole life. B. Universal life. C. Variable universal life. D. Indexed universal life. Answer: C. Variable universal life. Variable universal life, VUL, insurance offers the flexibility of universal life combined with the investment control of variable life, meaning the policy owner can vary premiums and death benefits, and also direct the cash value into various investment subaccounts, such as stocks and bonds. This policy requires the policy owner to bear the investment risk, and it is regulated by both state insurance departments and the SEC. The variable component signals the investment risk and choice. Question 25. Which of the following is an example of an unfair claims settlement practice by an insurer in California? A. Refusing to pay claims without conducting a reasonable investigation. B. Promptly acknowledging communications regarding claims. C. Offering a fair settlement amount for a claim. D. Explaining the basis for a denial of a claim. Answer: A. Refusing to pay claims without conducting a reasonable investigation. Refusing to pay claims without conducting a reasonable investigation is a clear example of an unfair claims settlement practice. Insurers are obligated to thoroughly investigate all claims and act in good faith when settling them. Other unfair practices include misrepresenting facts or policy provisions, failing to affirm or deny coverage within a reasonable time, or attempting to settle claims for less than the amount to which a reasonable person would have believed they were entitled.